I think what we're going to do today is just talk a little bit about how the markets have been overall, and then we'll move into the portfolio with Mohan and Jim. As we wrote to most of our investors, we had pretty optimistic expectations that the beginning of the year would be quite strong, and we've seen that illustrated across most of the indices. Really, it was a lot of investors thinking that they had finally figured out how to time the market, and they really were just pretty late on the trade. We've seen the indices have really healthy gains. It's been off the back of probably better than expected or not as bad as expected earnings announcements and economic readings, especially related to inflation, that have started to taper down. We're seeing things such as Meta, which had been badly beaten up and leading into the end of the year, up dramatically, along with other of these tech names that have started to cut economic earnings and are allowing themselves to better perform. And we've seen investors really reward that. On the interest rate side, the Fed signaled that they're certainly coming to the end of the really aggressive rate hiking cycle that they've been going through. And will we expect to see some continued rate hikes through the rest of the year? It seems like we've got the worst of it behind us. And I think really that a lot of investors out there are looking for a massive pivot, but it's probably not going to come because that inflation is probably going to take a little bit longer to come down than most people expect. Having said that, having 5% interest rates is not really the worst thing in the world, and it's really just going to direct capital to higher quality projects. So over the longer term, we're not as concerned as we were at the beginning of the year about inflation. We think the Fed will continue to temper investor expectations in the near term, and that will probably mean that the US markets are probably reaching a bit of a peak here, and we wouldn't be surprised to see a bit of a pullback over the next month or two. Europe's also done exceptionally well. They managed to get through what's been a pretty difficult situation, especially related to energy. They do have some inflation concerns, and we think they'll probably be more aggressive as they push forward. But thankfully, that's probably going to be tempered by the removal of China's zero COVID policy. That really caught the market off guard. I think more than anything, it drove expectations that things were immediately going to get back to normal. They're probably not going to, but eventually they will. But more than anything, it probably puts the supply chains back into effect. And I think we're going to continue to see that inflation tempering. So overall, we're generally pretty positive, but we wouldn't be surprised to see a bit of a pullback come in here now. At this point, I think I'd like to hand it over to Mohan, and he can talk a little bit of how the portfolio has been doing, and then over to Jim to talk a little bit about the financial condition of the company.
Okay, thanks, Mike. Hello, everyone, and thank you very much for joining us today. We very much appreciate your time. As you know, we segment our portfolio broadly into two buckets. One bucket is legacy investments in the cannabis space, and the other bucket consists of new investments in diversified sectors, including technology, biotech, etc. And so what I'll do today is I'll run through some select corporate updates and highlights from the portfolio and sort of give you a sense of what's happening at some of the portfolio companies. So let's start off with the legacy investment bucket. I'll talk about four companies. I'll talk about Delivra Brands. I'll talk about WeedMe, which is our biggest holding. I'll talk about Sequoia, and I'll also talk about Southern Cannabis. So let's start with Delivra. So what is Delivra? Delivra is one of our longest term holdings, I guess. We've owned it for quite a while. The company successfully transitioned over the last couple of years from being a cannabis cultivator to becoming a consumer products company. A major development at the company recently was the sale of the Lucky Lake cannabis grow facility to another group for $3 million in cash. That press release came out a few weeks ago. Lucky Lake was the last outstanding major asset the company owned that was related to its prior incarnation, I suppose you could call it, as a cannabis cultivator. And so now with all those legacy sort of assets gone and legacy issues behind it, we're looking forward to a period of sales growth runway for the company with their consumer products. They can utilize this new capital towards marketing and distributing, their Dream Water and Live Relief product lines. And actually, some of that's already starting to pay off. I don't know how many of you check Delivra's press releases, but they recently announced that they've signed a deal with Hilton Hotels to sell Dream Water and hold them across 450 Hilton Hotel locations across the U.S. So we like the transition there from being a cannabis cultivator to a consumer products company is basically complete at this point. And so we're pretty happy with that. The next company I'll talk about is WeedMe. It's our largest holding. It's a leading cannabis house of brands here in Canada. And it's been, one of the rare success stories in cannabis, having grown their business multiple fold over the past 3 years, while most of the competitors have actually had to scale down dramatically, right? So December and January are historically, weakest months of the year for cannabis as a whole and for the company as well. But they've still done quite well, actually. They've still sort of hit record, numbers for those sales numbers for those months. And so we're quite happy with that. So, seasonally adjusted, the revenues continue to exceed our expectations. And we're quite pleased with how that revenue line continues to develop and the profitability line continues to develop. And what the management has sort of indicated to us is that they believe the company will continue to grow revenues materially higher, even more in 2023 over 2022. So very, very sort of positive developments there. And given the landscape in cannabis globally, and particularly in North America, they have tons of acquisition opportunities, actually. There are companies that have reasonable amount of sales, but are underperformers in terms of operations. And there is an opportunity for the company to pursue that if it chose to. And, it's not just customers and investors that are sort of recognizing, how well WeedMe's doing. We wouldn't be surprised if they got an operating line from a major Canadian bank soon, and that would allow them to accelerate their growth even more. So we're quite happy overall with the progress at WeedMe, and we continue to be happy shareholders. Next, I'll talk about Sequoia Cannabis. Sequoia is a European, extraction company, and they produce some of the highest quality GMP certified extracted products in Europe. They had very strong sales in January, which is back on a positive track after, what was a seasonally weaker December. And management is having ongoing conversations with major international food and drink companies. These are sort of longer term projects and clients that could lead to large deals. And while management's focused on that, the salespeople that they've recently hired are generating the immediate and medium term revenues for the company. And now they have a pretty decent cash balance and can hire even more salespeople. And the existing sort of 2 salespeople that are generating orders, and additional salespeople are expected to push revenues towards a new high. So that's the goal we've set for management in 2023. We want them to achieve a step function higher in revenues with the new sales force. And so overall, we're more comfortable with this company than we have been in the past, simply because there's a higher margin of safety with a better cash balance and more sort of sales effort. So we're very positive and looking forward to how they perform in 2023. And the last sort of legacy investment I'll talk about is Southern Cannabis. So Southern Cannabis is Australia-based cannabis clinics and brands company. They also had record-breaking revenue and EBITDA in December, actually. And they expect to see double-digit millions in sales next year. So this has been another high-growth story in our portfolio. And, they're planning to make the 2023 projections, which are quite aggressive. They intend to make those happen with new brands. So they recently introduced the Isoflora brand, and, they're also planning to build out a larger sales team to distribute these products outside of just their own clinics. So we're very excited about what 2023 holds for Southern Cannabis and how it can take advantage of what's a rapidly growing Australian cannabis market. So those are the 4 sort of legacy investments that I wanted to give you an update on. And now let me kind of give you an update on two two sort of investments in the new diversified sort of sectors, I guess, and both are biotech companies. So first I'm going to talk about Valo Therapeutics, and then I'm going to talk about Media Labs. So Valo is basically a European cancer immunotherapy company that's currently undergoing a phase 1 patient trial. We invested in these guys about 18 months ago. They've been setting themselves up to conduct this phase 1 trial. It was a bit delayed. They were hoping to get it going in the summer of 2022. So there was a 6-month delay, but they are there now. And they recently received 2.5 million in new funding from investors. And they also got 2.2 million, I believe, in euros from the EU for further development of their cancer drug. So, and particularly the funding from the EU is based on, scientific and financial submissions from the company. So that's a real vote of confidence. So these new investments have cleared a pathway for the company to pursue their phase 1 study. And they've already begun recruiting patients actually this month to go through the study. And so we expect to see results from the study this fall. And, that'll be the next major step function up for the company. So that's Valo. So now let me sort of give you, a bit about our other biotech investments, Media Labs. So what is Media Labs? It's a California-based testing company. They provide tests across a variety of indications, including COVID. The company has been dramatically ramping up sales and the number of tests it conducts per week over the last several months. In February alone, they're expecting to do about roughly 3 times the number of tests they did in December. So this sort of dramatic growth is what led Hygrovest to invest in the company's capital raise last year. And using that money, the company is now rolling out UTI and respiratory test panels with their customers. And they've even purchased a new qPCR line to run those tests. So that basically prevents them from having to delay to get additional licensing. And they can roll out those tests without having to go through the licensing process all over again. And so currently some of the tests are being outsourced to other labs, but they expect all tests to be done in-house by April, May 2023. And this coincides with a move to a larger facility in April. And so management is focused on getting this move done right without any interruption to business. And once in the new facility, we expect the company to triple the number of tests they do from February. So the ramp up in terms of the number of tests and revenue that the company is generating is going to be very dramatic. And we expect the company to become cash generating in the very near term as these tests ramp up. So overall, I guess what I'd say in summary is our portfolio of investments continues to be stable, predictable. It's a big turnaround from a year or two ago, where especially the legacy investments were that entire market was in flux. And now these companies have actually responded to the challenge. They've got their cost structures right, and they're actually succeeding quite well in what's a challenging market and gaining more market share. And so we're quite proud to be investors in the companies I talked about today. And with that, I'll pass it over to Jim, who's going to lead you through some of our financials. Jim?
Thanks, Mohan. Just a couple of points in addition to what Mike and Mohan have gone through. We released our January results last week. Basically, they were flat. The report, though, did highlight the performance of Weedme. Continues to be our largest investment, about 50% of the portfolio. The table in the portfolio update shows that they've generated substantial sales and also a profit growth in the last financial year, which was 2022. So those figures would suggest that the valuations that we're carrying these investment at are reasonable. The audited results will be out before the end of February. Hygrovest remains well funded. We've got about $5 million in cash, which is available for further investment and operating costs. One last point is that we're obviously awaiting a liquidity event for Weedme. The thing that's holding that back in part is that the Canadian listed market remains flat, and therefore we're dependent upon the recovery and the demand for equity investment in the cannabis space. I'll leave it at that.